Breaking news. Our third time around the block on second quarter GDP. Exactly as expected, 2%. Rear view mirror, that's what it was our second look, and that's what it is today. Personal consumption, however, dipped a bit. But keep in mind, it dipped from 4.7 to 4.6. These are still really powerful numbers. On our core personal consumption expenditure, quarter over quarter up 1.9. The price index 2.4. The 1.9 is a little hot. Now, let's look at our August read on trade balance, which is a deficit, $72.8 billion, sequentially following $72.3, and that's actually just a smidge higher than the $73.4, $73.5 we're expecting. All right, let's get into jobless claims. Last week, there were 208. That gets revised to 210. Add 3,000. 213,000 is the new number, and 1.65 million on continuing claims, which is a bit down from 1.665. You think we're done? No, we're not done yet. We have some inventory numbers for the month of August. Retail inventories unchanged. Wholesale inventories up 0.4. That's a big jump, up 0.4. So we want to definitely monitor any potential changes that come in through that revision process that affect gross domestic product. Andrew, that was a lot of numbers. Interest rates haven't moved much. Still holding gains in pre-opening equities. Back to you.
Thank you for that, Rick. Stick around. I don't want you to go anywhere. Joining us right now is Knapp of Ironsides Macroeconomics. Also, CNBC senior markets commentator Mike Santoli is here, and senior economics reporter Steve Liesman. Steve, first over to you, as you've been on that computer looking so professorial.
I'm thinking of like a Bugs Bunny cartoon where, like, you look at the kitchen and everything's fine, you turn off the lights, and the mice come out, and they open up the door, and then you turn the lights back on, and everything's fine. They're all gone. There's a lot going on. The top line number on GDP is super boring. It was 2%. It is 2%. It's running 2% Q3. Going on all around the 2% is the trade data, which is boosting the inventories, which will be runoff in the inventories. You've got Boeing accumulating planes, which is having a long-term impact. I had a long talk with Mike England about the impact of Boeing, which makes the 737 MAXs but doesn't sell them, so that boosts inventories. And then you come up with all that drama on the outside to come up with 2%. And I watch the data come in every month, every week, every day, and they go into our rapid update, and it comes out 2%. The consumer, 4.7. We've had this little slowdown. It's important to talk about in business investment. It was up 4.4. Now it's down 1%. The big change there is going to be in structures, down 11%. They're not building buildings, I guess, is the deal. Government purchases are really helping, and the consumer. So you bottom line, the government. And by the way, just a kind of a little footnote here. Everybody completely had wrong the effect of the government spending from 18. They all counted in 18. The way the government works, it actually is still helping in 19, that big surge in spending. And then you have the consumer doing well, partially because of that, but also because wages and employment are doing well. So
I see
that's the story.
Bugs Bunny. I see the Roadrunner where Coyote runs off the end of the cliff and he's standing there fine until he looks down.
And then
there's
I don't see it that way.
Okay,
so
good.
I'm pretty
right,
optimistic.
Good. That's what scared me. That's where I thought you were going.
We've been able to maintain this 2% with a lot of stuff going on. World trade is falling, or some of our partners are doing very badly. You could probably put back 0.25 to 0.5%. I think if global GDP were doing a little bit better, that would surge our exports. But world trade is falling. You know, people were talking earlier this morning, what would be the impact of ending the trade war? I think it'd be pretty substantial.
In terms of what it means for the numbers on trade, or in terms of what it means for the markets? What are you?
Well, the markets, there's lots of smart people who deal with the markets. I would just say from an economics point of view, we might be shaving 0.25 to 0.5 point off of our GDP, in part because it's coming off of there. And I'm not saying that trade is the only thing bugging the world, but we know it's one of the big bugs of the world.
Well, for me, the real issue that you're kind of getting at, but is most important here, is that in 2018, on the back of the Tax Cuts and Jobs Act, we had an absolute surge in capital investment in structures for 6 months, but more importantly, in intellectual property products and software investment. And that boom was likely related to the surge we had in productivity. which has now gone on for 6 quarters.
And the tax cuts. Don't forget that. That was a big part of the surge.
That was my point. It was on the back of the Tax Cuts and Jobs Act. You had this big surge. So if you think about what's going on this year, you had weak consumption in the first quarter, largely because of the stock market crash in the fourth quarter a year ago. It rebounded in the second quarter, just like what happened in '87, right? And now it's kind of trending back towards this 2 3/4 or so trend. But the mix has shifted. You're no longer getting that surge in investment. It's been cut in half. To me, that is the trade war and the uncertainty, the hit to business confidence. So,
and by the way, that's what Mark Weinberger told us earlier today, too. It's just that. That's what CEOs are doing.
We're in a really critical spot for that right now because the long-term trend is capital investment tends to run below trend in presidential election years because of policy uncertainty. Right. Getting some sort of trade detente now and restarting that capital investment would be crucial to getting that momentum. Mm-hmm. Some of this is secular, right? The investment in software is clearly secular, but getting that restarted would be crucial. And then the issue, too, is the mix of growth is more inflationary this year than it was last year. Last year was a supply shock that lowered trend inflation. This year, being skewed more to consumption and less to investment actually spurs inflation. And guess what? Last 4 or 5 months, we're running well above the Fed target on every measure.